live. Today I have with me Felix from Cowswap. And yeah, I'm really excited because I feel like we haven't seen so much innovation in the DEX space since Uniswap and Sushi came about. Well, Sushi is just a clone of Uniswap really, but I guess Balancer and then the DEX aggregators came. But like in the last year or so, we haven't seen that much innovation. So I think Cowswap is really trying some cool new things, and I'm excited to talk about that with Felix. Welcome, Felix.
Yeah, I'm super glad to be on the show. Thanks for having me, and excited to talk about Cowswap with you.
Maybe let's start with a quick introduction of yourself and maybe also, how you joined the project, because I know it started originally as a project incubated by the Gnosis DAO, which is doing a ton of other projects as well. And how did you get involved? Was it your idea? And why did you decide to spin it out?
So it was not my idea, actually. It came out of the necessity from Gnosis to build efficient market mechanism for the prediction market platforms that they initially raised funds for during the ICO in 2017. And so I joined Gnosis in summer 2018. Before I was working at a big tech company at Facebook and was interested in cryptography and also interested in the intersection of game theory and finance. And I still knew Martin and Stefan, the Gnosis founders from university. And so I decided to join their team and basically started to work on research for multidimensional batch auctions with uniform clearing prices, kind of the mechanism that is underlying Cowswap today, with the intention of making it a trading mechanism for prediction market tokens. So we spent 1 year in the research phase. We've built a first version of the protocol. Back then it was still named Gnosis Protocol back in 2020. We took a ton of learnings from it. And in 2021, we reiterated and built the protocol that's now known as Cow Protocol. And with that, we found product market fit. We thought we finally had something that actually got a lot of traction and actually is something that is a meaningful improvement to what we have, and so we decided to take it solo and develop it in and of itself.
Does the prediction market protocol still exist, or is that deprecated?
I think Martin Stefan would say the focus shifted. For me personally, I actually feel like prediction markets were delivered from Gnosis. So we built the framework to create prediction markets. We worked on kind of an Oracle solution, and basically all the parts are there. But the focus of Gnosis was never to market or be in the business of creating and entertaining the use cases of prediction market. It was more to build the tech, and that has been done. And now the focus then has shifted to Gnosis fund storage with Gnosis Chain now, other sidechain and layer 2 solutions, and with Gnosis Protocol, more efficient market mechanisms for DEX trading.
Amazing. Well, let's dive into Cowswap protocol then and how it works.
Maybe the easiest way to explain it is that what Cow Protocol does is adding a very thin batching layer on top of existing decentralized exchange mechanisms in Ethereum. So today, when you're trading on Uniswap, for example, you are actually signing and sending off an Ethereum transaction yourself to the network. And then the only thing that can happen in that transaction is what you signed it to do. There's your transaction is kind of isolated in being included in the block with multiple other transactions, but in and of itself, what the transaction does cannot be altered or changed in any way. So what Cow Protocol does is it basically allows you to delegate the concrete execution of your trade to a third party. So instead of actually signing an Ethereum transaction, all you're doing is signing an off-chain message saying, I'm okay trading this token against this token at this price. And then you hand off that message to a third party, which will actually find the best route and execute that trade on your behalf. And what this allows this third party to do is not just execute your trade individually, but actually add other people's trades. So for example, if we were both trading around the same time, the same token pair, then our two trades could be batched together and executed together against the best on-chain liquidity source. But even better than just having two people trade in the same direction would be if people are actually trading in complete opposite directions. Let's say I'm buying ETH and you're selling ETH, then we don't even have to reach out to Uniswap or some AMM at all. We can fill at least the smaller of the two orders directly peer-to-peer and save on execution costs, save on slippage, save on just the liquidity provision fee that we pay on Uniswap, and thus get structurally better prices than if you were to or everyone were to just execute their trades individually.
And that last part is a huge piece of the protocol, right? This is literally what gave the name of the protocol, these coincidences of ones or cows. I think it makes a lot of sense intuitively when you hear it, that this is just a superior way of just matching transactions. It's kind of also how it's done on an order book, no? Where also two coincident, well, two people want something and they're brought together, or is that a bit different?
No, I think it's in traditional finance, at least, it's very different in that there is this concept of time price priority. Basically, if you see an order in the order book and you want to match it and you're the first one to match it, then you will be sure to get that order. And the order that you find in the order book, well, could be from a retail user, but it tends to be from a market maker or a professional party. The new thing that Cowswap allows is it kind of breaks this continuous time illusion that exists on decentralized protocols today, because on Ethereum, we only get a new block every 15 seconds. And even though the ordering of transactions within that block matters for the price that you end up getting in your trade, it doesn't really make a lot of sense because the block is executed at the very same instant. All the transactions in there are executed at the very same instant. There's no real time difference between the first and the last transaction in the block. There's no guarantee in the protocol that if I send my transaction before yours, I also get included or ranked in the block higher than yours. And so what our protocol allows is to break kind of this continuous time illusion and make it so that if you're trading within a block on the same token pair, you're actually also guaranteed to get exactly the same price. So there's no priority if you place your order 1 second before mine or a millisecond before mine. And so it copes with a bunch of value extraction strategies that we know from traditional finance, like front running, but that have been increasingly severe and painful in Ethereum, where, basically users are getting run over by bots that know how to optimally order their transactions within a block and make sure that the user gets the worst price that they're still just fine paying.
Yeah, let's maybe quickly talk about these MEV opportunities, that it's not something positive, but yet this thing that happens when people trade on directly, often on decentralized exchanges such as Uniswap. You mentioned front running, for example. Can you maybe explain how that negatively impacts a user to later understand how Cowswap prevents that from happening?
So when you place an order on Uniswap today, it might look like you're actually placing a market order because it quotes your price and then you just click on swap. But what happens under the hood is that you're actually placing a limit order telling Uniswap you're okay trading at the price that the interface quoted you, plus some what's called slippage tolerance, some buffer that if the price moved, because everything is asynchronous, the time between you signing your transaction and it actually being mined, there could be seconds or minutes between those, the price might move in the meantime. So in order to cope with these race conditions, you're telling the Uniswap protocol, hey, here's my limit. If the price stays within this bound, please execute my trade. Now, if a miner sees your transaction in the mempool and sees the current state of the Uniswap and your limit, what they can do is they can insert a transaction just before yours that actually moves the current Uniswap price exactly to your limit price. So making sure that your transaction still passes, but at the worst possible price for you. That is called front running, front running is when they insert something just in front of your transaction. And there's also back running, where your transaction might move the state of one pool, but there might be another pool, for example, on SushiSwap, that now is an imbalance. The price on SushiSwap is different to the price on Uniswap. So a miner might say, well, let me just rebalance the two pools and make sure that they are coherent in terms of price. That is called back running. And then probably the meanest aspect would be front running and back running combined. So moving the Uniswap pool to your pain point, executing your trade, and then moving it back to where it was before, basically sort of buying low and selling high, and therefore making an atomic profit without any risk.
That's called the sandwich attack, right?
And that is a sandwich attack, and that is what Cowswap aims to protect users from.
I feel like it's so hard to explain to end users like why MEV is bad, and I feel like most people don't really care because, like you said, they go on Uniswap, they see a price that's quoted, and at the worst they will receive that price, right? So they don't have an expectation necessarily to get a better price, and even if they get sandwich attacked or front run, what they see is that they were quoted a price and they received that price, and they weren't really expecting to get anything better than that. And so I, like most people, don't really know whether they get like sandwich attacked or whatever, and hence it's hard to. I think at some point there was like this tool that came up. Maybe it was even developed by you guys. I'm not sure anymore. Only then you could basically paste your address and it would show you how much value you lost as a consequence to being front run. But I think only a subset of crypto users are actually sophisticated enough to care about these things.
Yeah, I think a lot of users care, just a lot of users don't know. So if you ask users, if you explain to them what is sandwiching, they'd be like, whoa, this exists and I'm getting run over. So nobody wants to get sandwiched. Nobody wants to spend 0.3% of their trade, just basically give it away to somebody for free.
Yeah.
However, you're right that a lot of people don't know about it. And something that we've noticed quite painfully also at Gnosis is just building kind of a superior mechanism, or what we believe is superior mechanism, doesn't necessarily mean that the market will follow and come. I think with Cowswap, we have hit kind of a nice balance between actually having a protocol that under the hood, we can explain why it's structurally better than what is out there today. But at the same time, it's playful, it has like a Uniswap style experience. It's memey. It has this cow sound at the end when you trade. So we do have a lot of people who come for the meme and then stay for the tech. But yeah, we also have to do a better job at surfacing that kind of problem to people and making sure that MEV doesn't just become something that users are getting used to and kind of gets allocated to the Ethereum security budget and that's it. But actually make users aware that, hey, there's mechanisms that can fundamentally reduce the amount of MEV that's out there. You benefit if you use these mechanisms.
And now that we have a good understanding of what MEV is, can you explain? I know you touched upon it before, but can you explain how Cowswap prevents that from happening? Because in the end, you are still, or this third party solver that is executing all of these end user transactions on Cowswap on their behalf. This party is still executing a transaction on chain. Can this not be front run either by others or by the solver themselves? Is there how does it prevent these MEV opportunities from arising?
Yes. So one thing that I maybe haven't explained super clearly in the beginning is that it is not just one solver that is taking care of the execution, but it's actually a network of solvers that independently try to compete against one another for the best kind of batched execution. So think about it as a competition for order flow. You're placing an order in the system, I'm placing an order in the system, and then periodically all the solvers receive the current instance of the auction. So all the orders that are in the system. And what they're trying to do is to find the best clearing price for all these orders to execute them with as much price improvement for the users as possible. So if your limit price is buying ETH at $2,500 and I can actually make it so that you buy ETH at $2,400, then I'm giving a $100 price improvement, $100 surplus for you. And so we sum up all the surpluses, and then protocol basically just decides which solver gets the right to settle the current batch, gets the right to execute the order flow. And at that point, the solver has already committed to the price that it will achieve for the user. So the user is guaranteed that regardless of the ordering that the settlement gets mined in the block eventually, they will receive that clearing price that the solvers have competed on for them. And so it's eventually up to the solver to make sure that they don't get sandwiched. So in some way, solvers are taking away the MEV risk, the sandwiching risk from the user. And well, how solvers can prevent them? I mean, one is if we find these coincidence of ones, these peer-to-peer trades, then these kind of trades are not MEV prone at all because there's no on-chain state that can be raced against. They are just being traded peer-to-peer. But of course, the majority of trades still hits on-chain liquidity, and there can be MEV resulting from that. And so what solvers do to kind of typically is integrate with flashbots, making sure that they set very tight slippage bounds themselves, of course, looking at the current volatility and chances of failure. But basically a solver is a professional entity, kind of it's their bread and butter to make sure they can execute transactions reliably and without being sandwiched. So it's much better to let them do the hard work than to expect from every MetaMask user to protect themselves. Or even flashbots is one way of how you can protect yourself, but that's only gives you a fraction of networking power, so your trades might take longer. And so there's adaptive strategies on how you can strike a good balance of having a tight slippage tolerance, making sure that you're trading as close to the current state as possible, but at the same time avoiding being reverted or having a failed transaction when the price moves against you.
Yeah, one thing that I've often wondered about when I was using Cowswap. Basically, make an order, or you say you want to buy, you want to sell like ETH, and then you get like a price offer, and you accept that. You submit the signature that you said, this off-chain signature, and then often you have to wait, and that depends a bit on, I guess, how often batches are submitted and so on. And I think it also reduced this time that you had to wait, reduced over time. I remember when I used Cowswap the first time 6 months ago, it was like half an hour, and nowadays it feels closer to 1 minute or something. What I was wondering is, how is it possible that I receive a price offer at point X in time, like in the present, and if the batch is like settled on chain much later, like 10 minutes later, then like who guarantees that at the minimum I receive this price? Because as we know, a minute later or 10 minutes later, prices on these DEXs might have moved quite a bit. So is that the solver that is sort of taking this risk and guaranteeing a minimum price? Or
Yeah, so some things to unpack here.
Okay.
In normal conditions, batches should be settled with roughly 1 minute delay. So when you experience 30 minutes, then there was likely that we had either an enormous backlog of orders, or maybe the network was super volatile at the moment. There's probably something that wasn't going right at the moment if you had to wait 30 minutes, or the price moved out of bounds. So basically your limit price was not respected, and then it moved back in after 30 minutes. That is kind of what could happen. Basically, what you're signing as a user is very similar to what you're signing on Uniswap. We're looking at the current state of the network and what price we could achieve right now, and then we're adding some slippage tolerance, which opposed to on traditional AMMs won't get sandwiched away. So you can actually choose a 1%, 3%, 5% slippage tolerance, and you'll be fine. And then for an EOA, it's quite simple. The order becomes, as soon as you click sign, the order becomes valid, and we try to solve this order for you. But there's other use cases, for example, multi-signature wallets like the Gnosis Safe or DAOs, who can also integrate with Cowswap, where it can take minutes or hours or even days to collect all signatures. In that case, we need the user to set a sufficiently large slippage tolerance in order to guarantee that their order also will be executed at the time that the order becomes valid. All the signatures are collected. However, unlike on traditional exchanges, in case the price actually moves in your favor, your large slippage tolerance will not actually be used against you and will be extracted away, because solvers, even at the time when your order becomes valid, will still compete for getting you the most price improvement. So as long as there's at least one honest solver that's actually trying to get you the best execution, you will get your full slippage tolerance plus the price improvement actually delivered to you as a surplus. Now, of course, if the price moves against you, and so maybe that's a misconception that solvers don't guarantee you the price the moment that you hit the swap button. If the price actually moves against you and is out of bounds, the smart contract will prevent any solver from settling you outside of your limit price. So we cannot at all violate your limit price. So if your limit price is no longer satisfied, then your trade will not go through and it might expire. However, even in that case, you haven't paid any fees, you haven't wasted any gas. So unlike on other protocols, where if your slippage tolerance is exceeded, your transaction ends up failing and you might spend $100 on a failed trade. On Cowswap, basically all you need to do is reissue another trade intent, and you will only pay a fee if your trade gets settled.
And these cows or coincidences of ones, I feel like that's really the coolest aspect about Cowswap. How often are they found in a batch? How much is settled on other DEX's liquidity versus like peer-to-peer?
I mean, I cannot tell you in terms of volume, really. I do know that last time I checked was around between 6 and 10% of the batches were settled, where basically had a cow in them. And so, of course, this is not yet sufficient. This is not yet where we want to be. We're still at the very early stage, and this product lives a lot with network effects. If people individually use Cowswap, we won't be able to find cows. But if everyone that's trading on Ethereum were to use Cowswap, we would be able to find many more of these coincidences of ones. So it's about getting more people to use the protocol and to use the platform. And we are also planning some more kind of features where we allow people to basically delay their trade to wait for a cow, making sure that if you're trading USDC against ETH, for example, you do so maybe every 5 minutes or every 15 minutes to make sure that We then have like a canonical batch in which we collect all the ETH USDC orders, and then make sure there's a big liquid batch where we can match a lot of the volume peer to peer. We also have a Twitter bot called Mooing Cowbot, which is actually looking at trades and posting when it detects a cow. And so this is one way of finding some examples for cows. But as I said, we are not yet where we want to be in terms of the efficiency of cows. But this is also a reason why we're spinning out and why we're creating this standalone entity in order to be able to bootstrap these network effects.
And I guess these cows are found much more frequently for the highest volume trading pairs, like you said, ETH and USDC versus long tail tokens, like some governance token, random DeFi project. Is that the case?
Yeah, that's the case. So basically stable coins, Ether, Bitcoin are like the most liquid token or the most heavily traded tokens, and those also generate the frequent cows. There's a direct correlation between trade frequency and cow potential. And as I mentioned before about these canonical batches, if we want to start with the most liquid pairs for those, but we can potentially also extend those to long tail tokens, and then there would just be a canonical batch of, GNO or BAL once per hour. And so if you wanted to make sure that you benefit from cows, then you would just say, okay, put me into that batch. That would only happen, every 15, it depends on the frequency the token is traded. But we could make these like happy, canonical batches for each token.
So basically, as a user, I would say I am willing to wait 10 minutes and my price is for selling ETH is, let's say, $3,000. And then within those 10 minutes, one solver is going to try to match me with a corresponding sell order.
Yeah, so this is one way where you wait for cows, and then if your threshold is reached, you basically say, okay, in that case, just hit the best DEX aggregator that you can find. Another mechanism could be that we actually say, well, everyone who wants to trade GNO trades it at every quarter hour. And so if you come in at now, let's say 55, then if you place an order now, it would only become tradable on the batch that happens at the full hour, basically. And then we would hope that within these 15 minutes, we can collect 2 or 3 or 4 people that are on that trading on that token pair, and so making sure that then the canonical batch that happens every 15 minutes it's deeper and has more orders in it for the long tail token.
I see. And when you find a cow, for the user that receives a cow or however you want to call it, does that mean they don't have to pay any fee except maybe the gas fee, of course, that the solver has to? Or no, there's no gas fee in that case because it's not on chain. Maybe you can just explain whether what kind of fees and how, if it's cheaper for the user.
So right now we estimate the fee for each order regardless of how the order was settled after the fact. So basically, when you place an order on Cowswap, we just check how would this order be executed today most efficiently. That of course depends on the size of your order. If it's a small order, then likely the most efficient settlement would just be using one single AMM pool directly. If it's a large order, then the best execution might be to go through a more complicated DEX aggregator. And so we basically just try to compute what would you pay elsewhere, like what is your best other option. And we of course that results in a gas fee, and that gas fee is measured in ETH, but we don't actually make the user pay any gas. We actually take it from the sell token. So we convert that gas fee into the sell token amount, and that is the fee that we charge on the order, regardless of how it gets executed later on. If it's in a cow or if it's not in a cow, that from a fee perspective, that doesn't matter. Of course, the price that the user gets, the execution price, is likely going to be significantly higher if it was settled in a cow, just because you don't have to pay the LP fee, you don't have to pay any price impact. But right now, the protocol observes the execution price, basically the saved gas costs. Theoretically, the estimation of how much fee to charge you could take this into account. How likely are we to generate a cow? What is our expected gas cost? And basically charge you based on that. We could even, one thing that we're thinking about is to bake the fee into the execution price. So basically make you pay zero flat fee, but basically make sure that your execution price allows for a little bit of your surplus to be redistributed to the protocol. And then we could do things where, really depending on the executed path, we charge you more or less fees. But right now we just check what would you pay elsewhere, and then we even subsidize this slightly. So basically we make sure that it's cheaper than what you would pay elsewhere. And then that's what the protocol takes. And if the protocol is able to execute you cheaper, then right now this is how the protocol.
One thing I was wondering about is how do DEX aggregators and maybe even DEXs see you guys? Because I could see like a point in the future where you reach like really critical mass, and this percentage of trades that are where cows are found is getting higher and higher, and you're basically bypassing the on-chain DEXs completely and siphoning away like a lot of the volume from them. Is that do you see yourself as a competitor to these DEX aggregators, or more like an enhancing product, a layer on top that makes them just better?
Definitely more the latter. Definitely more an enhancing layer on top that fixes some of the MEV inherent MEV issues that AMMs surface today. For long tail tokens, in the long run, I mean, we want to significantly increase the number of cows that we generate, but for long tail tokens, we will, the majority of volume will very likely still require on-chain interactions, and AMMs are a great innovation in the space that is definitely not, we don't see them going away anytime soon. We actually see both DEX aggregators as well as DEX projects as partners. For DEX aggregators, we route a lot of our volume through DEX aggregators, so that's like a mutually beneficial place to be in. We are also right now working on rewarding solvers with protocol tokens to make it, eventually also incentivize DEX aggregators to run their own solvers and build cows on top of whatever matching algorithm they have for single orders already today. With regards to AMMs, we're actually interested in experimenting also with AMMs that would give exclusive access to only retail users or to only people that are willing to trade in batches. Because we feel like today a lot of the value and the reason that AMMs work is because they're arbitrageurs that equilibrate them whenever external prices change. And so that in itself also creates a race. And if there's a $50 arbitrage opportunity, you can ask a searcher how much they get, but they're paying the vast majority of that arbitrage opportunity. They pay in gas fees and tip to the miner to make sure they actually get that arbitrage opportunity, the $5 or so that then end up in their pocket. And so we think that we can move a lot of that value that right now gets thrown to the miner away by basically creating a mechanism that's not prone to racing, and then redistribute those $45 to, of course, the people that are making the markets, that are making sure markets are efficient, but also to the people that are providing liquidity and that are running these, that are basically fueling these AMMs, and of course retail traders who right now also get beaten by that. So really our goal is to reduce the amount of MEV that exists and then redistribute that MEV value back to the different participants, liquidity providers, traders, and professional market makers, of course.
Really interesting. So you're saying many of the solvers today are actually run by the DEX aggregators themselves because they want to like funnel liquidity towards their own DEX aggregator, and so they're like trying to solve these trades in an optimal way and competing with other solvers that are also DEX aggregators. Is that right? Or
I mean, the solvers are still run by Gnosis. So Gnosis it's facilitating the APIs of the DEX aggregators. So it's asking the 1inch API, how would you solve this trade? It's asking the Cowswap API, how would you solve this trade? And so, yes, we are definitely using the logic or the matching. Our Gnosis, the Gnosis solver is highly dependent on the matching logic of these DEX aggregation solvers. But of course, what we would like to get to is having these projects build out custom solutions where not only a single order can be matched optimally against current on-chain liquidity, but also a set of orders could be given to them, and then they see like, oh, actually here's a one hop that can be combined, or here's actually a hop that cancels each other's out because somebody is selling a token for USDC, somebody's buying a token for USDC, but both share the USDC ETH hop in the middle. So there's various ways of how we can make those more effective. But in the past, we've been working quite closely with the project, and so far we've been, I guess, providing a lot of, or at least significant volume to their platforms as well.
What is the challenge of sort of decentralizing this solver role if you're saying that Gnosis is currently running the majority of them? Is it just too complex at the moment or not enough interest? Technical constraint?
It's definitely a technical constraint. So first and foremost, in order to decentralize the competition, we need to really finalize or finalize the rules of the game. Like, what are you competing on? What is the game that the solvers are playing? And for that, we need to make sure that there's no way that a malicious solver could obey the rules of the game, but still try to screw over. And as long as we make sure that, as long as right now Gnosis is running the solver, so we actually know kind of, what logic they're implementing, and we know that's in the best interest of the user. And we are working very hard right now. That's kind of the first step of what we're doing to formalize these rules of the game and actually come up with a mechanism that is then, up for, of course, debate and review if that's actually, if there's no loophole in it, but that's really right now the challenge we're working on momentarily. But even if we have kind of the rules of the game defined and then solvers can send solutions to the protocol, we then only have so much control over what happens on a smart contract level. Like on the smart contract level, we can verify the limit price. We can make sure that there's no tokens kind of, stolen or like we can kind of make sure that some basic constraints are satisfied. But then for the competition aspect, making sure that actually the solver that reported the highest objective value also gets to execute. They execute in time. They don't censor kind of, other orders or so. For this, the infrastructure needs to be decentralized as well. And there needs to be a bonding mechanism, making sure that if a solver misbehaves, they can get slashed. And so there's some more, I would say, economic thoughts on how to also decentralize the infrastructure. And so we'll focus first on decentralizing, finalizing the rules of the game, making sure everyone can participate in the game, but still leave submission up to Gnosis. And then as we advance there, we can have a full solution submission by any party and even have redundant solvers running the same code to make sure that if one 1-inch solver goes down, there's another 1-inch solver that can catch that falling knife.
That's basically, progressively decentralizing. What's the timeline looking like for this two-step approach?
Yeah, so we started now, I think tomorrow. So the proposal, one of the first proposals of the DAO ends to start paying out rewards to the solvers, which is a first step to incentivize people or make people care more about actually building solvers. And so we hope that this will increase the amount of thought and also pressure that goes into finalizing the rules of the game. We really hope that we can do that kind of this half in the next 3 to 6 months, make sure that the game is solid and can be played. And then we will look a little bit also on how the appetite is for decentralizing, because the infrastructure itself, because one thing we noticed with Gnosis Protocol back in 2020 is that we focused very much from day one on making everything maximally decentralized. And then we realized, well, we built something that users don't really use or appreciate. So what's the point of having a fully decentralized version of it? So we will have to balance our focus areas with other parts, like layer 2 expansions, like, adding more liquidity sources. So we'll have to see about it. But of course, it is definitely, we have a plan. There's a roadmap ahead. It might be a year or two out before it's absolutely completely decentralized.
What are the incentives looking like for submitting or building a solver, like you just said, which is something that's starting tomorrow, if I understood that correctly? What, you get some, like a fixed amount of cow tokens for doing that, or how does it work?
Yeah, so it's up to the DAO to decide, and we were starting extremely simple with a flat 100 cow reward for the winning, for each winning solution, on top of course, the gas costs that the solution incurs. So solvers are getting rewarded their execution cost plus 100 cow token bonus. But we will see if that, and that's right now also only for mainnet. So we'll see if that works out, if there has to be some consideration of how valuable a batch is, maybe in terms of volume or number of trades in it. And on top of that, we also still have an ETH Denver remote hackathon bounty out that I think rewards $7,500 for a solver contribution or a solver implementation. And I think this is also something that in the future, the DAO would be interested in continuing to basically provide grants or pay part of the research and kind of investment overhead upfront. And then as the solvers perform, hopefully the tokens that they receive will be an incentive to continue.
I see. And so this token at the moment, my understanding is that it's not tradable at the moment, right? Because I also received some, and my understanding was that it's going to be unlocked after a DAO decision. So at the moment, these solvers just receive some locked cow that they cannot trade instantly, correct?
Yeah, right now VCow is a pure governance token. It's not tradable. Really, the purpose right now is to govern the protocol and to decide what should happen with the protocol. And one thing that may happen, or we already see it in the forum kind of evolving, is that the DAO will decide to make VCow actually tradable, and in that case, then it would become a regular tradable ERC20 token.
But still only a governance token at first, without any, I don't know, buyback mechanisms, or is there actually any revenue? Does Cowswap in its current form make any revenue, or would that be something that would be added later on top of the current solution?
So the protocol itself makes revenue from the fees that it incurs from the users trading, and so the revenue is actually quite significant. I think to date it's been somewhere around $11 or $12 million in revenue. However, of course, it also has significant costs because it needs to pay out the solvers their gas costs and the rewards. And so right now we have, I would say, significant revenue compared to some other DeFi projects, but we also have significant or high costs. And so
how does that compare to the 12 million?
It's a 16 or 17 million in costs so far over the last 10 months.
Wasn't the revenue lower?
Yeah. So I mean, right now the protocol is not making money, so we're spending money. We're not making a profit right now, but we believe that this is reasonable, or that's okay to do in order to bootstrap the network effects, and basically we already see that as the number of users grow and the batches get denser, our execution costs go down. So we think that even with the current cost structure, it is possible to make the protocol profitable. But yeah, so right now there's no. It's up to the DAO to decide how to make use of Cow and what to make out of it. Definitely buybacks are an option. I think one idea that is floating around in the forum right now is to start with certain fee discounts based on your Cow balance. So the more Cow tokens you have, the bigger your fee discount would be, and in that sense, it gives like some incentive for people to hold the token. But again, that is also up for the DAO to decide. What I mentioned earlier, when we decentralize the solver infrastructure, we likely need a bonding and slashing mechanism. It's possible that Cow can be used there as well, given that it's used for solver rewards. It might also be used for as a collateral or like as a potential penalty. And yeah, as you said, buybacks for fees is it's a logical step that the DAO can take at some point. I think right now the protocol will focus more on what is the ratio of kind of what can we spend on growth and on customer acquisition versus how much revenue do we make. And once that is positive, we can think about how to distribute that.
Yeah. What type of user have you observed is like the typical Cowswap user, if there is one? Is it like with DEX aggregators? It's always been said that it's mostly big whales that care that much about execution. They're willing to pay higher gas costs and so on. But I'm curious if I could also see why some more like retail traders would like the experience of not having to pay gas up front, basically, and maybe they like the cow sound as well.
Our user group has been a little bit a blessing and a curse at the same time, because we are actually not targeting a single user group. We have all of the users that you said before, but of course, when it comes to curating a roadmap and focusing on what should we next build, it's a bit hard when we say, well, we see people trading $70-80 million, making $70-80 million trades on Cowswap, but then we also see a lot of people that are trading coins we've never heard of before, and that are coming from some Reddit forum, or like they're definitely like newer to the ecosystem. We had somebody that was a huge fan of just the cow meme and even created bed sheets with our background to follow around. So there's really like a majority, like a vast, very diverse group of people using the protocol. Another user group that's super important to us also is DAOs and multi-signature wallets, and even just on-chain fund management protocols such as Yearn, Set, or other larger protocols that have to make trades, because we really think we can structurally give them a better mechanism to do their trades. But yeah, so we at the end of the day, we want Cow protocol to be the primary price finding layer for digital assets on Ethereum. And so if you're a whale, if you're a retail user, if you're a protocol or a DAO, we want to cater to you. And so basically we're not restricting the protocol itself on a specific user group, although there might be in the future different interfaces maybe catering to different levels of financial literacy. And
how has your process of becoming a DAO looked like? I mean, it's a special situation, like being spun out of another project, and I guess you didn't really have a community back then that was specific, at least to your product, because you were part of something bigger with multiple products. So are you sort of starting from scratch now? And what was your experience of like bootstrapping a community of users who are interested in what you're building?
Maybe one way, like one primer is that the spin-off from Gnosis is a super, is not a unilateral spin-off that we decided to go away. It's a bilateral decision. Actually, Gnosis was very happy to divest a little bit their focus and make sure that the people working on the project also take more ownership in them and basically make sure that there is a community around it and try to find a governance vehicle for them. And so kind of our experience was quite surprising, because we have kind of all the, was very positive, because we created in April last year, we created this protocol and had a lot of people join because they really liked it. They liked the user experience, they liked the UI. So we created a Discord quite early on that was focused on Cowswap and separate from Gnosis, where we had tremendous growth and tremendous community engagement, also on Twitter. And so we kind of built this cow specific community way before Gnosis decided that it would be a good idea to spin out Cowswap. And so in a way, we have the community from day one. At the same time, we have kind of the expertise and all this experience in the ecosystem and kind of professional support on the legal side, on the recruiting side, on the DevOps side, all these things coming from Gnosis. So really, it's been actually quite a good experience, I would say. Our first couple of proposals have gotten over 4,000 people voting on them. So it's really, the engagement of the community is quite impressive to see.
I guess it also helps that you've taken a really community first approach very early on, letting, sort of putting the airdrop criteria online and asking for feedback, and then you got feedback, you made changes to the airdrop criteria. You were also the first protocol to airdrop options, like purchase options of your token at the same valuation than VCs who had invested in the last Cowswap round. I believe it was like $150 million valuation. How did that like land with users? Did a lot of them purchase these options? Did you have a feeling it was a success? Because I found the mechanism really cool and revolutionary.
I think it's a little bit, I mean, I'm more on the technical side, but we think it was a success. I think about 50% of the user options were drawn, while only 75% of the airdrop was drawn. So there's like 2/3 of the people that could invest also did invest, which is quite nice to see and impressive. Yeah, I mean, the community has definitely, there were people complaining about the airdrop criteria as well afterwards, and saying that there's always, when there's an airdrop, there's always people complaining that they should have been considered. But yeah, as you said, we published them beforehand. We got some feedback that we also acknowledged and changed the criterias and so slightly, and so from our end, I think it rests to see a year from now, 2 years from now, how the initial token distribution actually turned out in terms of like governance decision, participation rate, and if we can create a successful DAO. So it's a little bit early so far. I think also other projects within Gnosis are considering similar styles.
I mean, it's really the ethos of DeFi, right? To create the same like rules for investing than for everyone, and not just like have VCs get the best conditions. But I found it funny because in for example, like a lot of people that I talked to were saying that the lockup is so long, 4 years. It's in DeFi you never know what happens in 4 years. So it feels like many normal users then, when they get the opportunity to invest in like in a really good project at the same terms than a VC, they're actually not willing to take also the drawbacks that come with that, namely like lockups, investing into account. But we'll see how it goes. Maybe to finish, you mentioned layer 2s as part of your focus for the next couple of months. Can you tell us a bit about how soon that's going to happen? Which layer 2s you're prioritizing? Will the product be exactly the same then on layer 1, or will it be like slightly adapted to layer 2, for example?
So we actually decided that for the immediate roadmap, we will not focus so much on layer 2, so at least for the next couple of months, because we feel like there's a lot of potential to strengthen and solidify the experience on layer 1, and also that's where gas costs, these days are much lower, but still where like some of the value propositions are unique. Kind of in terms of strategy, of course, deploying on other side chains or layer 2s that are EVM compatible. So Polygon comes to mind. We already deployed on Gnosis chain, but some other kind of project. I mean, basically any chain that is EVM compatible can run Cowswap in its current form and also have the same user experience. When it comes to actually making sure that we can add some more value on just copying the existing experience on different networks, because that in and of itself would also again fragment our network effects, and having 100 users on 5 networks is not as good as having 400 users or 300 users on one network. And so one of the value adds that we could add, for example, on cheap side chains such as Gnosis chain or Polygon, would be to allow people to trade, to sweep in liquidity from other chains. So for example, if you find yourself on Polygon and you want to buy a coin that doesn't have deep liquidity on Polygon, but basically it would require you to bridge to mainnet, execute your trade on mainnet, bridge back to Polygon, because we already have this kind of delegated trade execution flow where solvers execute the trade on your behalf. We can abstract all that complexity away from the user and basically have you trade on Polygon, but under the hood, the liquidity gets swept in from mainnet and you don't even see it. Of course,
would that just be like a UX advantage of not having to do it yourself, the whole bridging back and forth, or would there also be a cost advantage?
I mean, we can
do it for you.
With bridging in itself, you can have kind of coincidence of wants, right? If you want to use the bridge in one direction and I want to use the bridge in the other direction, we could just net the funds like outside of the bridge. In this specific case, we're thinking more of like professional entities providing that liquidity. So what they could do is, see that a coin is now gaining traction. It's been a new coin. It's been added to Uniswap, and maybe make sure that they already bridge over sufficient amounts to then market make not just the one user that is currently trying to buy it on Gnosis chain, but also the next 5. Or we could also again there have like longer, have canonical batches once an hour, once a day or so, where that's when we do the bridging of this long tail token all in one together. So there, in the very basic form, it's the convenience aspect, but there are ways of how we can improve it and actually make it also a structural advantage, maybe at the cost of some longer wait times or not immediate trade, which from some of these coins is actually quite important, because when the token goes up, then people want to jump on it as soon as they can. So I was going to say the holy grail, like, because I was talking earlier about like fragmentation, and it's not so good to be have 100 users on each platform. The holy grail would be to create batches across different layers, and basically if you're trading ETH against USDC on mainnet and I'm doing that on Polygon, then we can still find a cow across chains. That's of course the holy grail, to have like one price per asset across all chains, but that still requires some significant research on our end, and so we're still quite a bit away for that, but it's also something that is part of our vision, because we do think that batching and the fragmentation, or with our approach defragmentation of liquidity markets across chains, across different tokens, is something we can address with this mechanism.
Definitely, if you manage to solve this, would be huge. And how is the deployment on Gnosis chain going compared to layer 1? I mean, probably like on Gnosis chain in general, there's much less volume than on Ethereum, so I expect the Cowswap volume to also be much less. But are you seeing enough interest? Do you find that a success?
Definitely find it a success because it allows people that want to trade smaller amounts to do so at actually reasonable prices. Of course, we had some user experience issues in the beginning where some tokens have almost no or just really bad liquidity on Gnosis chain. But if you're trading the main tokens, then liquidity is actually fine. Of course, if you trade large amounts, then that also becomes a problem. But if you trade large amounts, you're usually not on Gnosis chain. The volume is much lower, that's true, but the velocity is actually similar in terms of number of trades. I don't have the stats off the top of my head, but it's, the number of trades or number of batches we settle per day is not significantly less on Gnosis chain. It's just the volume or value that is traded is much less. But we definitely see these kind of, Gnosis chain together with the kind of this opportunity or this way of sweeping in liquidity from mainnet, we see as something where smaller users or retail users can then really have the best of both worlds, like cheap transaction fees, but then if necessary, if actually the token is not available on that chain, still being able to tap into the best liquidity pool that lives on layer 1.
Thanks so much for your time, Felix. That was really interesting. I learned a lot about Cowswap, and really excited to see where this is all going in the next couple of weeks. There's a lot of interesting things you talked about, and I want to see it all come to life.
Sure. Well, thank you very much for having me. Thanks for the good questions, and it was great chatting with you.